Good morning, ladies and gentlemen. On behalf of Capital Trust Research Private Limited, it gives me immense pleasure to welcome you to our research webinar on the earnings of selected listed companies for the first quarter of financial year 2023. A number of positive developments have taken place recently, including the easing off of fuel and gas shortages as well as power cuts, establishments of political stability, and the release of June quarter corporate results that have significantly outperformed market expectations. Further expectation of reprofiling of Treasury bond and signing of staff level agreement with IMF at the end of this month will further boost the stock market. We believe that these factors, combined with the current historically low valuations, provide a healthy entry point for investors wishing to buy stocks in the Colombo stock market. Therefore, we believe it is a suitable time to recommence our webinar series. Today's webinar will cover Expo Lanka Holdings PLC and tile sector stocks, Royal Ceramics PLC, Lanka Wall Tiles PLC, and Lanka Tiles PLC. We are pleased to remind you that Capital Trust Securities is ranked number 1 for the calendar year 2021 and so far in calendar year 2022 in terms of transaction turnover, brokerage turnover, and number of transactions. Today's webinar is the 32nd of a continuous series of webinars that Capital Trust Research Private Limited has been hosting. During the last 24 months, Capital Trust Research has been at the forefront in correctly identifying the Sri Lankan rupee depreciation and has been continuously recommending dollar income stocks such as Expo Lanka Holdings PLC through its comprehensive research reports and webinars. Furthermore, in the last 24 months, we have also been correctly identifying the hyperinflation, which is currently prevalent in Sri Lanka, and have been recommending diversification into the tile sector companies and cable sector companies which have monopoly power. Capital Trust Holdings Limited and Capital Trust Properties Private Limited would like to make a disclosure that in the past several years and at present, they are substantial shareholders of the stocks being covered today. Hence, investors should do their independent research before investing. Now we are pleased to introduce Mr. Hasitha Liyanage, Head of Research of Capital Trust Research Private Limited, and Mrs. Divyakasi Chetty, Head of Corporate Finance of Capital Trust Partners Private Limited, who will make the presentation. They will be happy to answer those questions you may have at the end of the Q&A session. Over to you, Divya.
Thanks, Prashani. During this webinar, we will review the first quarter financial year 23 performance of Expo Lanka and companies within the tile sector. Given the significant changes in the operating environment over the last quarter, we believe it is the right time to revisit these counters. Let's first take a look at Expo Lanka. Strong financial performance continued in the first quarter of financial year 23, despite the first quarter generally being a slower period for the company. Expo recorded a top line of 235 billion rupees for the quarter, which is a 145.67% increase year-on-year. Generally, the revenue is split approximately 60% and 40% between air and ocean segments. However, air freight volumes reduced by 23.8% year-on-year, while ocean volumes grew by 8.3%. This was mainly due to the focus in developing the ocean freight product and increased customer penetration within the segment. As a result of this trend, the revenue in the first quarter of financial year 23 was dominated by ocean freight, which contributed 62% to the top line. EBIT margin strengthened to 10.59% in the first quarter from 8.28% a year ago, reflecting higher yields brought about through efficient procurement strategies, strengthening of network, and enhancing overall service offering. Profit after tax to equity holders increased from 6.3 billion rupees to 20.1 billion rupees in the first quarter of financial year 23, reflecting a 220.61% increase year-on-year. Total comprehensive income increased from 6.3 billion rupees to 40.4 billion rupees, a 544.5% year-on-year increase during the first quarter. This was mainly due to the significant depreciation of the rupee compared to other major currencies. The group is expected to continue to record strong earnings in the financial year 23. As reflected in this table, Capital Trust Research forecasts the net profit attributable to shareholders at 82 billion rupees. The total comprehensive income for financial year 22 was recorded at 99 billion rupees, with 6.27 billion rupees recorded in the first quarter of financial year 22. In comparison, the total comprehensive income of 40.4 billion rupees was recorded during the first quarter of financial year 23. Considering Capital Trust Research expectation of a further depreciation of the rupee to 420 rupees by the end of financial year 23, a total comprehensive income of 127.14 billion rupees has been forecasted for this financial year. Let's look at what's happening with the freight rates. Freight rates dropped 6% to $6,159 in July 2022 per 40-foot container, driven by rate decreases on Asia to US West Coast and European lines. This rate is 39% lower than a year ago, though still more than 400% the pre-pandemic rate. Ocean rates for the week ending 5th August from Asia to US were largely flat. China's military exercises have not disrupted ocean freight operations as vessels continue to transit from Taiwan's main port located in the area. Lower demand due to Chinese and Hong Kong COVID lockdowns and recession fears in the West, along with inflation's impact on consumer demand, have led to an increase in available capacity and lower ocean rates since May 2022. COVID lockdowns and bad weather have slowed things down in Chinese ports, while port congestion has shifted to the US East Coast from the West Coast. Recent decrease in demand, which has led spot prices to decline, was the result of manufacturing orders being cut due to changes in consumer spending behavior. However, now the situation is changing again as the trade routes are experiencing congestion and are seeing container rates moving higher. In June 2022, US container import volumes increased by 4.9%, suggesting strong consumer demand despite rising inflation and increase in interest rates. As peak season begins, the National Retail Federation forecasts strong US import volumes to continue in the second half of calendar year 2022. Further demand normalization and unwinding of congestion may take place at a slower pace than expected. Therefore, it is expected that ocean rates stabilize and remain above pre-pandemic levels during the second half of calendar year 2022. After a record-setting spring, imports at the US major container ports are expected to slow significantly for the remainder of the year, but 2022 should still see a net gain over 2021. As per the National Retail Federation, the retail sales are continuing to grow approximately 6 to 8%, but the US economy is slowing down, and that will be reflected in cargo imports. The graph on the slide reflects the US monthly data on retail imports. When looking at the data of the first half, it is evident that import volumes are higher in the first half of calendar year 22 compared to the corresponding period of the previous year. However, the forecast for the remaining 5 months from August onwards is expected to be slower than in 2021. Despite this, 2022 overall is expected to record a total of 26.3 million TEUs, up approximately 2% from the previous year. Draw your attention to the graph on this slide. The graph reflects the rates for a 40-foot container from China to US East and West Coast. The rates have significantly come off compared to the same period in 2021, with rates at $9,885 for the East Coast and $6,632 for the West Coast. Correction in freight rates were visible across both air and ocean freight as capacity returned to the market, albeit still at elevated levels, given that we are now heading towards the peak season demand. Due to this and the prevailing port congestion, ocean rates are expected to stabilize and remain above pre-pandemic levels in the second half of calendar year 2022. This is due to the increased fuel prices and congestion in the supply chain. COVID lockdowns in China limited production and resulted in excess capacity. This led to a decline in China to US rates during the past 3 months. According to industry sources, ocean freight rates in some of Expo's origin markets, such as Vietnam, Cambodia, India, and Bangladesh, have not mirrored the China-East Asia rate decline. Therefore, when analyzing the impact of freight rates on the profitability of Expo, the movement of China-East Asia ocean freight rates should not be looked at in isolation. Rates across its global network of 34 countries should be considered. Despite ocean freight rates softening, Expo has successfully maintained gross profit margins at 15.7% in the first quarter of financial year 23. The company is expected to continue to maintain margins through efficient procurement strategies using a mix of spot and contract rates. Freight rate volatility that is currently prevalent is also expected to support Expo's price negotiations and further optimize margins. Global air cargo volumes fell again in June as additional airline capacity applied downward pressure to the freight rates. Rates are now largely flat and expected to remain at these levels, which are above pre-pandemic levels during the second half of calendar year 2022. Now that we have a better understanding of the market rates, let's look at Expo's air freight segment performance. As mentioned previously, the air segment contributed 38% of revenue during the first quarter of financial year 23, compared to the 58% contribution during financial year 22. The quarterly data reflects a decline in volumes by 23%, recording 32.9 million kilograms compared to 42 million kilograms recorded in the first quarter of financial year 22. Despite the challenging backdrop, Expo secured capacity via efficient procurement strategies and constant dialogue with carriers to ascertain gaps and identify opportunities in the market. Volumes are expected to increase quarter on quarter, with the expected increase in seasonal demand in the second and third quarters of financial year 23. The softening of air rates have resulted in margins of approximately 11% for this segment. The ocean segment continued to record consistently strong performance, building off last year's effort in developing the ocean freight product and increasing customer penetration. This segment recorded a 9% growth in volumes in the first quarter of financial year 23. Ocean segment contributed 62% to revenue during the first quarter, up from 42% top-line contribution during the last financial year. Customer preference for this product, along with Expo's focus on this segment, is expected to drive growth. Rates are expected to soften in financial year 23 due to recession fears and easing of consumption, but expected to remain elevated with the commencement of peak season demand and congestion at destination and origin ports. The segment margins are currently approximately 16%. Although rates have softened across both segments, ocean freight rates are less affected. The company focuses on building capacity, and bookings generally for ocean segment is between 3 to 6 months. Let's take a few minutes to discuss the key growth strategies adopted by the management to ensure sustainability of earnings going forward. Expo's focus on consolidating and increasing their presence in both destination and origin markets have assisted in driving growth and strengthening margins. Expo's recent expansion to Thailand and other East Asian markets that are origin markets, and Denmark and Belgium in Europe, and Canada, which are destination markets, emphasizes its strategy of consolidating presence. The growing worldwide presence enables the company to work directly with their customers instead of through agents, and also captures both ends of the transaction, contributing to an increase in its revenue and margins. Ongoing investments in infrastructure and technology has supported the growth and improved overall efficiencies. The investments have assisted in creating transparency through end-to-end visibility to customers. Further, it has resulted in driving operational efficiencies through standardization of back-end systems across its network. The company continues to develop their ERP platforms, offering integrated solutions within its global network. Over the last year, Expo has been successful in acquiring over 10 new strategic customer accounts and deepening wallet share of key client accounts. This has resulted in a steady volume growth over the year. The strategic customer base is based on strong relationships, providing Expo a strong competitive advantage. The model is structured such that the business no longer goes through the seller, but rather the brand. The company has built the necessary capacity with both air and ocean liners to serve the customer demand, and also has presence in multiple markets. This provides an edge to Expo to win over the business by providing total logistics solutions across multiple geographies. This strategy will contribute in ensuring strong volumes are maintained through financial year 23. Enhancing their service offering by providing total solutions to customers is a key growth strategy of the group. Presence in the US domestic logistics and providing customers with an array of support services assists in further strengthening their offering in one of its key growth markets. Acquisitions is a key long-term growth strategy going forward in order to build capabilities and infrastructure. Through acquisitions, the group has enhanced their service capabilities and offering, and thereby is able to offer total solutions to customers to match their supply chain requirements. The company is open to opportunities to strengthen its capacity and capabilities and presence through inorganic growth. The agile structure of the group and the strong balance sheet is also integral in supporting the growth going forward. In addition to the strategies that we previously discussed, the management also adopts the following yield management strategies to sustain volumes and enhance margins. This has been done to ensure the long-term sustainability of profitability at these levels or beyond, even when the rates eventually ease in the medium term and when supply-side constraints ease. We must note that just because the pandemic ends doesn't mean that their profit growth stops. The company is focusing on fundamentals to reduce earnings volatility in the future, and we expect a continuation of robust earnings growth. Although rates have come off due to lower consumption and recession fears in the US, rates are expected to stabilize and remain elevated in the next few months, with peak season demand and port congestions resulting in capacity constraints. At present, rates are very volatile, especially for air freight. This volatility offers limited visibility and therefore assists Expo to price its products in a manner where margins can be maximized. As mentioned before, increasing presence across destination and origin markets assists Expo in controlling both ends of the transaction. Working directly with customers instead of agents also results in enhancing both revenue and profitability. Proactive procurement policies are also Expo's strength. With the support from their parent company, SG Holdings, and relationships built with carrier partners over the years, Expo is able to efficiently book capacity while maintaining strong profit margins. Maintaining volumes and increasing wallet share with key strategic customers by further enhancing service offerings are integral to Expo's success. Key recent acquisitions, mainly in the American domestic logistics space, has enabled the company to increase its wallet share and provide end-to-end solutions to its key strategic clients and further strengthen their margins. Expo's parent, SG Holdings, support in terms of capacity procurement, funding, working capital, and expansion plans provides Expo with a competitive advantage. Having discussed the logistics sector, let's move on to the leisure and investment sectors. Let's start with the leisure sector. Classic Travels rationalized its product offering during the pandemic and restructured its cost structures. The group focuses on corporate and experiential travel. The sector delivered a revenue of 727 million rupees and a profit after tax of 233 million rupees. Historically, this is the best performance by the sector, with the corporate travel portfolio driving the results. At present, the sector is primarily operational in Sri Lanka, and going forward, the company will focus on expanding this sector internationally. Within the investment segment, the management is focused on rationalizing its operations and restructuring its cost base. The sector recorded a revenue of 1.4 billion rupees and a profit after tax of 17.3 billion rupees, with the main contribution from export operations. The sector profit includes group dividends of 16 billion rupees. Expo has focused on realigning the sector to turn around performance, moving to high margin products with less volatility. As per the disclosures made to the CSE, SG Holdings has been purchasing shares of Expo and are enhancing their shareholding. As such, over the last few trading days, from the 3rd of August to the 8th of August 2022, SG Holdings has purchased over 346,500 shares between the price of 177 rupees to 210 rupees, further enhancing their shareholding of Expo. This is the first time the parent has purchased shares since June 2020. Expo is a global integrated logistics player, with 84% of its revenue linked to the US trade lane and the US economy. In 2021, Expo was ranked number 31 in global air freight rankings and number 49 in sea freight rankings. Therefore, when valuing the company, one must understand what its global peers and competitors are trading at present. This table captures some of its closest peers, and they are trading at an average forward PER of 15.96. It is important to note that Expo is currently trading at a 66% discount to its peers in terms of forward PERs. Also, the company's return on equity is 96.3%, which is 394% higher than the peer average of 24.38%. Although the first quarter is generally a slower period, Expo has performed exceptionally well in the first quarter of financial year 23. We expect this performance to continue throughout the year, with the second and third quarter performance being stronger, considering the cyclical nature of the business due to seasonal demand arising from Black Friday and Christmas sales. We expect rates, although softened, to remain elevated at these levels across the rest of the year. The prevailing volatility in rates assists Expo to price attractively while maintaining margins. In addition, due to proactive strategies adopted by the company, we expect volumes to be sustained in air freight with a moderate growth in ocean freight. Accordingly, we have forecast revenue for the financial year 23 to be at 958.36 billion rupees, which is a 38% growth over the previous financial year. We have conservatively assumed EBIT margins to marginally decrease from 10.6% recorded in the first quarter to 10.3% for the financial year. Net earnings are forecasted at 82 billion rupees for financial year 23, reflecting a moderate growth of 12.74%. Total comprehensive income is forecasted at 127 billion rupees, considering our expectation of the exchange rate to be at 420 rupees by the end of financial year 23. Expo is currently trading at a PE of 5.42 times financial year 23 forecasted earnings. We expect strong earnings growth despite conservative assumptions on volume and margins due to the expected global slowdown in consumption. Freight rates, although softening, are expected to stay elevated in comparison to pre-pandemic levels over the calendar year 2023. We expect volumes to be sustained in financial year 23 and yields to benefit from enhanced service offerings and expansion of footprint through increasing presence in destination and origin markets. With over 95% of revenue in foreign currency, including 84% from the North American trade lane, the stock provides a natural hedge for investors against the rupee depreciation and provides investors protection against the economic turmoil faced by the Sri Lankan economy. We forecast the rupee to depreciate to 420 per US dollar during financial year 23. Accordingly, we have forecasted a total comprehensive income of 127 billion rupees for this financial year. Expo is expected to trade at a premium to the market due to its global presence, high liquidity, and protection against the economic turmoil in Sri Lanka. Considering the peer average PE of 15.96 forward earnings and CSE market PE of 5.52, we assign a weightage of 50-50 on both of these multiples. Accordingly, we expect the stock to trade at a PE of 10.74 times financial year 23 forecasted earnings, resulting in a fair value of 450 rupees and 50 cents. I will now hand over to Hasika to discuss the tile sector companies.
Thanks, Divya, for the detailed presentation on Expo. Now let's move on to the tile sector that reported very impressive earnings in the first quarter of 2023, even though the market participants were expecting the sector to be impacted by factors such as lack of fuel and LPG used for production processes, increasing costs, and lack of fuel for distribution that will impact the sales. Having spoken to dealers and showrooms of Lanka Tile and RCL, we understand that due to dynamic management, RCL, LWL, and Tile continue to operate with higher GP margins as well as net margins in the first quarter of FY2023, even though certain raw material prices have increased over 70%. This was possible due to up to 100% increase in average selling prices, cost rationalization, and yield management strategies employed by management. The pre-order pipeline remains strong for RCL, with 6-month forward orders, while LWL and Tile operate with a 1-month forward order book, as it gives them the ability to reprice products when required. Domestic manufacturers, RCL, LWL, Tile, and Mac Tiles continue to benefit from the current restrictions on imports. With the increase in interest rates, residential construction declined, but as there was a 30% excess demand compared to the local supply due to the import ban, even after demand for tiles decreased to some extent, RCL continues to operate with a full order book up until February 2023. During 1Q FY23, RCL, Tile, and LWL implemented up to a 100% increase in retail prices, and the companies reported very strong earnings. This is despite Q1 being the lowest performing quarter for the tile sector, given the cyclical nature of residential construction. The increase in profitability in 1Q FY23 was possible, given the significant increase in retail prices, availability of raw material inventory at lower cost, and the implementation of cost rationalization strategies. This is despite costs of certain raw materials such as fuel and LPG, as well as chemicals and packing material increasing by 70%, given the rupee depreciation in the first quarter of financial year 2023. It is noteworthy to note residential construction activity picked up in the latter half of the second quarter FY23, with the availability of fuel improving across the country. In addition, due to the availability of fuel, normalcy in distribution operations is expected to support sales volumes from the second quarter of 2023 to the fourth quarter. The current market shares of the tile sector are as follows. The Lanka Tile brand, which accounts for both tile and LWL's production, enjoys a 42% market share. The RCL brand enjoys a 32% market share, while Tile enjoys 26% market share. With the continuation of the import ban on tiles and the increase in duties and taxes on sanitary ware imports, approximately 100% of domestic tile demand and 60-70% of sanitary ware demand is supplied by local manufacturers. As discussed previously, RCL, Tile, and LWL continue to finalize their capacity expansions, but due to the lack of USD in the banking system, where there were delays in importing the required equipment. As a result, we now expect the new capacity to only commence operations during FY24. The planned capacity expansions and budgets allocated are as follows. RCL plans to add new capacity of 3,000 square meters a day with an investment of 2.5 billion. Tile plans to add new capacity of 500 square meters per day investment with an investment of 244 million and expects to implement an additional 3,000 square meters a day capacity in the mosaic tile operation that will enable to expand exports. LWL plans new capacity expansion of 6,000 square meters per day at an investment of 5 billion rupees. During the first quarter of FY23, RCL, LWL, and Tile continue to benefit from yield management strategies, where the company shifted from the cheaper, smaller tiles to produce larger tile formats to increase margins, and also continued with cost management measures. As a result, profit margins increased at a cost as cost increments were successfully passed down to customers. This was possible given the RCL group's monopolistic market share, enabling the company to pass on the costs accordingly. Going forward, LWL and Tile are expected to increase export sales, given the depreciation of the LKR. Profit margins of export sales are expected to be in line with profit margins of local sales, given the current exchange rates. By increasing export sales, LWL and Tile will be able to ensure strong sales volume, even if domestic demand eases, thereby ensuring the sustainability of its strong earnings in FY23. Despite volatility of export markets due to the Ukraine-Russia conflict, Tile is expected to increase its mosaic and standard production in a bid to capture export market opportunities that have risen due to the disrupted supply chains. Foreigner plantations, on the other hand, posted strong revenue and profit growth in the first quarter of FY23 due to the enhanced margins, owing to robust tea prices resulting from the rupee depreciation. Despite the reduction of global aluminium prices, RCL's aluminium sector recorded losses due to the forex losses resulting in high finance costs. We expect the benefit of the reduction in global aluminium to benefit the sector from the second quarter to the fourth quarter of FY23. The packaging segment recorded exceptional results, with revenue growing 102% and PBT margins gaining 16.82% year-on-year during the quarter. RCL reported revenue of 14.7 billion during the first quarter of financial year 2023, increasing 39.23% year-on-year, primarily due to the increase in average selling prices within the quarter to combat spiraling energy costs. In addition to the core segment, Untitled Packaging grew its revenue by 102% during the quarter, recording revenue of 2.6 billion rupees. RCL's earnings before interest and tax grew by a staggering 76.31% year-on-year to LKR 3.84 billion rupees, owing to the changes in the product mix and efficiency measures to increase production volume. EBIT margins strengthened to 26.02% in the first quarter of FY23 from 20.55% in the first quarter of FY22. Profit before tax margins gained 5.78%, supported by margins of 24.1% for the packaging segment and 33.1% for the tile segment and 27.5% for the sanitary segments. Profit after tax to equity holders increased to rupees 1.29 billion to rupees 2.27 billion, a 76.09% increase year-on-year during the first quarter of FY23. Even though RCL recorded a 76.1% increase in net profits to equity holders in the first quarter of FY23, we have conservatively projected earnings across the second quarter to the fourth quarter FY23 to be in line with the second quarter to the fourth quarter FY22 earnings, thus resulting in a conservative net profit to equity holders amounting to 10.24 billion rupees, a year-on-year increase of just 4.6% in financial year 2023. If the group companies aren't impacted by fuel, LPG, and USD dollar shortages to ensure steady supply of raw materials, we will revise our earnings forecast upwards in the near future. As mentioned before, due to the proactive management strategies and the improved operating environment at present, we forecast a 15.56 billion increase in revenue on a year-on-year basis in FY23 to 66.5 billion rupees. PBT margins were conservatively assumed to decrease from 29.15% in FY22 to 26.66% in FY23. Profits attributable to equity holders is forecasted at 10.24 billion rupees, as mentioned before. Given the 40% dividend payout ratio, we forecast a very attractive dividend yield of 10.35% based on FY23 earnings. RCL currently trades at a market price of 35.7 rupees and a very attractive PER of 3.86 times FY23 earnings. As discussed previously, the operating environment has improved even under challenging economic conditions, with a full order book up until February 2023 and successfully implementing a 100% increase in selling prices to ensure profit margins can be maintained, even if costs of raw materials increase further in the second half of FY23. We have assigned a conservative PER of 8 times FY23 earnings to calculate RCL's fair value, reflecting the decrease in the broader market PE multiples. This results in a fair value of 73.9 rupees per share. We believe the PER we use for the fair value calculation is justified given the expected capacity addition of 3,000 square meters a day expected to come live in financial year 2024, and the prevalent restrictions in imports, ensuring the sustainability of current earnings. In addition, even if the ban on tile imports are eventually lifted, we expect imported tiles to be uncompetitive domestically due to the depreciation of the LKR, the prevalent freight rates, and a significant increase in cess applicable on imported tiles. Prior to the import ban on tiles, the imported tile segment had a market share of 46.5%. Since the implementation of the import ban, excess demand has been over 30%. Even if the residential construction does contract due to the increase in interest rates, we still expect the RCL group to operate at full capacity and earnings to remain strong. Moving on to Lanka Volatile. Lanka Volatile reported revenues of 11.48 billion in the first quarter of FY2023, growing at a very impressive 59.13% year-on-year. This was possible due to the tile and accessories sector contributing 55.3% of the total revenue, whilst the packaging sector contributed 25.4% of total revenue. The top line growth was supported by the plantation sector, which recorded a growth of 50% year-on-year during the quarter. Profit before tax margins gained 5.85%, reflecting strong margins of 34.8% from the tile and accessories sector. This was a result of the proactive yield management and cost rationalization strategies undertaken by LWL and its subsidiaries to ensure strong financial performance. Profit after tax to equity holders increased from 683 million to a staggering 1.66 billion, a 142.6% year-on-year increase. As a result, top-line growth and improved profit margins. EPS for the quarter was 6.07 rupees, while the book value per share gained 24.6% year-on-year to rupees 65.99. Even though LWL recorded a 142.6% increase in net profit to equity holders in the first quarter of FY2023, we have conservatively projected again that earnings across the second to the fourth quarter of FY2023 to be in line with the second to fourth quarter earnings of FY2022, thus resulting in a conservative net profit to equity holders amounting to 5.91 billion, a year-on-year growth of 15% in FY2023. If the group companies aren't impacted by fuel, LPG, and dollar shortages, that will ensure steady supply of raw materials over the second to the fourth quarter FY2023, we will again revise our earnings forecast. As mentioned before, due to the proactive management strategies and the improved operating environment, we forecast a 70.14% increase in revenues on a year-on-year basis in financial year 23 to rupees 46.69 billion in total. PBT margins were conservatively assumed to decrease from 21.89% in FY22 to 20.53% in FY23. Profits attributable to equity holders is forecasted at 5.91 billion in FY23. Given the 40% dividend payout ratio, we forecast a very attractive dividend yield of 14.42% based on FY23 earnings. LWL currently trades at a market price of 60.1 rupees and a very attractive PR of 2.77 times FY23 earnings. We have assigned a conservative PER of 7 times FY23 earnings to calculate LWL's fair value, reflecting the decrease in the broader market PE as well. This results in a fair value of rupees 151.75. We believe the PER used for the fair value calculation is justified, given the expected capacity addition of 6,000 square meters a day that will kick in FY24, and the prevalent restrictions in imports, ensuring the sustainability of robust earnings. In addition, even if the ban on tile imports are eventually lifted, we expect imported tiles to be uncompetitive domestically due to rupee depreciation and the prevailing freight rates, as well as the cess applicable on imported tiles. In the first quarter of FY23, LWL recorded strong profit margins owing to the availability of existing stock of raw material inventory at lower costs, which was used for production along with up to 100% increase in average selling prices. We expect the dividend payout to remain at 40%, resulting in a very attractive dividend yield as mentioned before, given the stock's current trading price. Moving on to Lanka Tile. Lanka Tile recorded net sales of 4.12 billion during the first quarter of FY23, growing 53.3% year-on-year. This top-line growth was supported by increases and transitioning to high-margin, larger tile formats, similar to what was discussed with RCL and LWL. Earnings before interest and tax grew by 94.64% year-on-year to 1.43 billion rupees, reflecting the effectiveness of the strategies employed to ensure strong financial performance. EBIT margins strengthened to 34.82% in the first quarter, gaining 7.4% year-on-year due to the company's ability to increase average selling prices and the passing on cost escalations to the customers. This resulted in the profit after tax to equity holders increasing to 1.16 billion rupees, gaining 87.3% year-on-year in the first quarter of FY23. Tile recorded an 87.3% increase in net profit to equity holders in the first quarter. Yet, we have conservatively projected earnings across 2Q to 4Q FY23 to be in line with 2Q to fourth quarter of FY22. This results in a conservative net profit to equity holders amounting to 4.62 billion rupees, which is a year-on-year growth of 12.4%. If tiles production isn't impacted, due to the shortage of raw materials, we will revise our earnings forecast, similar to what was stated with LWL and RCL earlier. As mentioned before, due to the proactive management strategies and the improved operating environment at present, we forecast a 20.3% increase in revenue on a year-on-year basis in FY23, resulting in revenue of 17.55 billion rupees. PBT margins conservatively were assumed to decrease from a very high for 34.52% in FY22 to 32.73% in FY23. Profit attributable to equity holders was forecasted at rupees 4.62 billion in FY23. Given the dividend payout ratio of 40%, we forecast a very attractive dividend yield of 13.05% based on FY23 earnings. Lanka Tile currently trades at a market price of 53.4 rupees and a very attractive PER of 3.07 times FY23 net earnings. Tile's fair value is based on a conservative PER of 7 times, similar to LWL. This amounts to a fair value of 122 rupees. Tile is expected to add new capacity of 500 square meters a day in FY23 and 3,000 square meters a day in its mosaic tile operation in FY24. We believe the PER used for the fair value calculation is justified, given the stated capacity expansions and the prevalent restrictions in imports, ensuring sustainability of earnings. Similar to LWL and tile, tile recorded strong profit margins during the quarter owing to the availability of raw material inventory at lower costs, which was passed on, sorry, availability of raw material of inventory at lower costs, and the passing on 100% increase in average selling prices to its customers. The dividend payout ratio in FY23 is expected to remain at 40%, given the strong cash balance at hand, resulting in an attractive dividend yield of 13.05%. That covers our update on tile. And over to you, Prashant.
We thank you, Hasita, Divya, and the research division for their valuable insights. Now, Hasita and Divya will take up the questions sent to the chat.
So we have a question from Mr. Fernando. Hasita, if you can take this. The question is, will importation of raw materials for Royal Ceramics get curtailed due to lack of dollars?
Yeah, sure, Divya. So basically, RCL has around $4 million of dollar deposits at the moment. Therefore, they can use those existing funds to fund its raw material imports, such as the chemicals, etc. But the main raw materials such as LPG and the other fuel costs are paid in rupees actually. So in terms of working capital, the dollar requirement is not really significant. But on top of that, with Tile's Mosaic operation expanding and the revenues expanding as well in over FY23, expected to expand, there'll be more dollar deposits as well, which will enable the company to import the raw material without any hindrance. So we don't really see that as a issue going forward where production will be limited.
Thanks, Hasita. There's another question again on the construction industry. The industry has contracted by about 40%. Therefore, will RCL have reduced production and profitability? Hasita, can you take that as well?
Sure. Yes, so just as we mentioned in the presentation, just giving you a background, prior to the pandemic, before the import ban, the imports accounted around 46.5% of total demand. Since the import ban, going back a few months ago, the demand-supply mismatch was around 30%, where demand exceeded supply of the local manufacturer by around 30%. Yes, with the interest rate hike, residential construction has slowed down. But still, as it stands, demand still surpasses supply. And in looking at RCL's order book, where the order book is filled up until February 2023, we don't really foresee a situation where sales will reduce below its production volumes and inventory build up. At the moment, whatever that is produced gets sold. So that's not a real issue at the moment in terms of reduced profitability and reduced revenues.
Yeah. So we have a question from Mr. Jaya Singha. Do you mean to say that Expo will go to 450 rupees, RCL to 74 rupees, LWL to 152, and Tile to 122? I'll take that question. So we actually don't give target prices. We focus and we give accurate forecasts on future earnings. Even if you look back at our past webinars and videos that are available, you can find that our forecasts are generally very accurate. So after we do a forecast and then we assign the profit attributable to equity holders, and we put a suitable PER ratio where we believe the stock should trade at, and then arrive at a fair value. So we don't go by target prices because we are unable to predict crowd behavior and we don't know where the funds will flow. So based on our fundamental analysis and our accurate forecasts, we come up with a fair value. I hope I have answered that question. Moving on to the next one, we have a question from Mr. Silva that is on Expo. I'll take that. So he has asked, with the current global inflationary pressures, particularly in the US and Europe, do you think that Expo will continue to record strong earnings growth? To answer, actually, we do believe that Expo will continue to record robust earnings growth. Expo has been successful in acquiring new key strategic customers during the last year and has been very successful in increasing their wallet share. As such, they're able to maintain their volumes on the air freight side and also even record moderate growth on the ocean freight side. Further, they have increased their presence across both origin and destination markets, helping them to control both sides of the transactions and go direct to customers rather than through agents. So this will help them even further enhance their revenue and profitability. So rates, yes, it is coming down, but it is still well above pre-pandemic levels. It's almost 400% more than pre-pandemic levels. So considering this, the prevailing rate volatility, the strong management and their procurement capabilities, we believe that Expo will continue to record strong, sustainable earnings in the future. There is another question, again, I think it's relating to Expo from Mr. Selvaratnam. It's based on higher inventory levels at retailers, what will be the impact on sea and air freight volumes over the next quarter? I'll take that question. So, I mean, yes, the industry as a whole will experience a reduction in volumes because there is high inventory levels and because we are expecting a further rate hike and therefore consumer demand and spending to come off. But saying that, Expo has adopted various proactive strategies and they will be able to sustain their volumes through the acquisition of new clients and deepening existing client wallet share. So we have very conservatively assumed that air freight volumes will just be maintained and ocean freight volumes will record a moderate growth. Moving on to a question from Mr. Pereira. This is on the tile sector, Hasita, if you can take it. LWL and tile don't have much order books. What is their position? How did their profits increase drastically in the first quarter?
Yeah, so basically, as we mentioned in the presentation, LWL and Tile have an order book of around 1 month, forward order book of around 1 month. But what really happened in the first quarter was the company put across 100% up to 100% increase in the tile prices. And yet, on the production side, they had built up inventory of raw materials, which were priced lower. So look, that was the reason why there was a sudden significant jump in their profit margins. That enabled the company to show extremely high profits in the first quarter. And that will give a cushion for the company to maintain elevated margins compared to FY22 in FY23, even in the backdrop of prices increase further, raw material prices increase further over the year.
Thanks, Asta. There's another question again on RCL, LWL and tile. Why did the share prices come down drastically when their valuations and their performance has been fantastic? That's a question from Mr. Siva. Hasita, can you take that as well,
sure.
please?
Basically, I think the market participants were expecting there to be production issues for the tile sector companies because of the basically fuel shortages, LPG shortages, which are both required for the production process, as well as the power cuts. So there was expectation that that will cause production issues as well as margin issues for the companies where the profits really rose. But that wasn't the case. Obviously, in the first quarter, what they reported on Friday, the results increased considerably. I think RCL profits increased 76% year on year. LWL's performance showed a 143% increase year on year, and I think tile was around 86%. So there was significant growth in the first quarter compared to the first quarter FY22, and this took the market by surprise. And we have accounted for that in our revised valuations and fair value calculations.
Thanks, Haskar. There's a question from Mr. Jayasekara. Is there a share buyback by SG Holdings? Based on a recent disclosure made to the stock exchange, SG Holdings did buy approximately 346,500 shares. And this is the first time that they purchased the shares after June 2020. We are not SG Holdings, and therefore we are unable to comment about their intentions and what they want to do in the future. But I would like to just draw your attention to the valuations. So we need to keep in mind that Expo is a global player, and they are trading at an attractive forward PER of just 5.42 times FY23 earnings, while their peers are trading at 15.96 times forward earnings. So in terms of valuations, Expo is very attractive. Then there's another question from Mr. Farooq Hasim. Any reason why Expo shares are not moving up fast enough? Are Sri Lankan investors so foolish and making negative remarks all the time? No company has made 140 billion in the last 5 quarters. I'll take that question. So, I mean, actually, Expo has been one of the best performing companies, and it is a truly global player that is consistently recording strong and sustainable earnings with a solid focus and a very good strategic plan. Their management is world-class, and as an organization, they're agile, and they're backed by a very, very strong parent. And the numbers actually speak for themselves. So, like I said before, we are unable to predict crowd behavior, and we don't give target prices. But based on all the research that we have done and the forecasts, and based on a suitable target trading multiple, considering both global peers and the local trading multiples, we arrive at a fair value of 450 rupees for this share. Moving on to the next question. There's a question from Mr. Akram Pasha. It's on the tile sector. Haste, if you could take this. How would the tile sector move forward with the following scenario? Dollar depreciation, shortage of raw materials with the import ban, the current economic turmoil, and the continuous increase of overheads.
Sure, let me just take that question. With regards to the dollar depreciation, yes, if the basically rupee depreciation, if the rupee depreciates further in the quarter, then there will be increases in fuel prices, which and LPG prices, which will have a impact on cost of sales, obviously. But at the same time, in terms of shortage of materials, as we mentioned before, basically the company does have some dollar reserves which they can import the required materials on their side. But if there is a shortage of fuel or whatever, then production will be impacted. But so far, we don't see that. But in terms of pricing, basically, as we mentioned before, the company already put across 100%, up to 100% increase in prices, and the profit margins actually went up considerably year on year. So the company can withstand increases in raw material prices going forward because they have that buffer. But at the same time, Lanka Tile and Lanka Wall Tile, since their order book is only 1 month, they can reprice their products and have strong margins. RCL, on the other hand, yes, they do have 8 months for the order books, which they can't reprice the products accordingly, but they have this buffer in the increasing margins, so they will be able to withstand it. So because the end of the day, the RCL group commands a 74% market share in the tile segment, so they have the ability to pass on cost increases to the customers. And that has been evident over the last year and a half, where the margins have continuously increased, even in an environment where cost of production has increased. So we expect that to continue. And on the demand side, since there's still a demand supply mismatch, even with the increase in pricing, we don't really expect that to be a big decrease in demand, where demand will be less than production. So we feel the tile sector is still attractive and will continue to perform really well going forward for those reasons.
Thanks, Asta. There's a question from Mr. Veerasinghe. How can domestic market-oriented companies reach their target revenue when the people's purchasing power has fallen in this crisis? Hasita, can you take that question?
So again, as I touched upon in the last question, previously there was around 30% where demand exceeded supply by around 30% for the tile sector. Yes, purchasing power has reduced, construction activity in general has reduced, but still the demand for tiles exceeds supply. But as we mentioned in the presentation, exports is another avenue that the company is exploring, because with the rupee depreciation, export margins are now almost equal to the local retail margins. So even in the unlikely eventuality there is excess supply, they're looking to increase the export sales. And regardless of the demand side locally, the Mosaic operation is expected to expand by 3,000 square meters a day. So export sales is going to be a focus, especially given the supply side disruptions because of the Russia-Ukraine crisis. The company is well placed to expand its exports. So they have options available to them, even if the local demand does come down below production.
Thanks, Hassan. There's a question from Mr. Silva. Will the reduction in freight rates affect Expo? I think we did cover this in the presentation, but I mean, yes, it must be noted that there is a correction in freight rates, and it's very visible across both air and ocean freight. But saying that the prevailing rates are actually 4 times above pre-pandemic levels, and we expect it to remain at these levels, especially even in the second half of the calendar year, given the seasonal demand expected to pick up. Other than that, what we need to keep in mind is also we can't only look at China to US freight rates. We need to look at other markets as well, other origin markets that Expo operates in, like India, Bangladesh, Cambodia, Vietnam, and so on. So I mean, Expo, as you all know, has presence in over 34 markets. So all of these also have to be considered. Other than that, a company like Expo also benefits from a period where there's rate volatility, because then, it's not so visible, and they will be able to use that for their advantage to even price certain contracts. And they use a mix of both spot and contract rates when it comes to pricing. Other than that, various strategies that they have adopted in terms of procurement, booking capacity, and all of that has actually worked in their favor and is reflective even of in the margins that they recorded in the first quarter. I believe GP margins were around 15.6%. So, I mean, freight rates reductions, you can't look at it in isolation only. The company has adopted various strategies which will help in ensuring that their earnings volatility is managed and their earnings growth will be sustained even in the future. Moving on to a question from Mr. Sahid. Given the higher growth percentage expected for financial year 23, both tile and LWL, should it at least command a similar PE of RCL? Hasita, can you take that question?
So basically, RCL is the holding company of LWL and tile. So if you look at its financials, in terms of revenue as well as profitability, is much higher. Yes, so if you look at a PEG ratio of sorts where the earnings growth does come into account, then valuations can change, but we need to look at other factors from different valuation methodologies as well. Basically, if you look at the liquidity side, RCL is one of the top 4 shares in terms of daily average volumes. LWL and Tile in terms of liquidity is lower. So for reasons state in terms of both scale as well as liquidity, we have assigned a lower multiple for LWL and Tile, and RCL we have valued it at 8 times.
There's a question from Mr. Pires. Will the stock market continue to rise? Hasika, can you take that question, please?
Sure. Basically, the market came down over the last few months for a few particular reasons. One was the lack of basic essentials from fuel to LPG. Another one was the political instability and the various protests that caused quite a bit of uncertainty. But now we've got the fuel queues are reduced. There's LPG available till December. Then there's a political stability to some extent. Then on the other side, basically T-bill rates have come off from its peak. Then inflation rates are expected to come off in future months with the reduction in food prices as well as fuel prices. And recently, with what was announced with regards to the T-bonds as treasury bonds as well, there is a possibility there will be some sort of reprofiling of maturities. So this is going to these are all positives for the market. The ground, the market lost over the last few months, it has been regaining. And especially with the reprofiling of treasury bonds as well, there's expected to have an influx of funds moving in from fixed income to equities as well, which will which might result in this run being sustainable, especially given with the increasing earnings as well. Earlier, the market was expecting earnings to come off considerably in this quarter, in the first quarter FY2023, but looking at most sectors, barring the banking sector, the earnings have been above expectation and the valuations being very attractive, and even the market PE being less than 6. So we feel the market has room to move up and reclaim some of the lost ground in the coming months.
Thanks, Asta. There's another question in terms of the tile sector. What is the expected percentage of mosaic tiles over the total sales of tile?
So I don't have that figure on me at the moment, but in FY2024, the company is expected to increase its production by around 3,000 square meters a day, just for mosaics. They see a lot of demand for mosaics at the moment in terms of export sales, but only limiting factor is the production volumes, the availability of capacity at the moment. So that will be addressed. So in terms of FY2024, we should see a significant increase in export volumes for mosaics.
I think that is all the questions that have come in so far.
There was one other question on Parquet as well, which I can address. There's a question where Parquet's performance was quite disappointing in the first quarter. What's the expectation for the rest of the year? So basically, with the rupee depreciation, there was a impact on the aluminum raw material. There was a repricing there. There was a forex loss basically. So that's a one-off. But in the future quarters, depending on the stability of the rupee, that should be addressed, and the performance will improve in the coming quarters. It was just this one-off costs, the forex loss that result in high finance income that caused a loss.
Since there are no further questions, I would now like to close the webinar. On behalf of Capital Trust Research Private Limited, I wish to extend a sincere thank you for our valued clients for their participation and the staff who organized this webinar. Hope to see you at our next webinar on next Sunday at the same time. Thank you very much. Have a nice day.